and welcome to this very exclusive webinar hosted by Elite Bankers Club. Today we are diving deep into the Reserve Bank of India's recently released half-yearly financial stability report, and guiding us through this crucial analysis is our esteemed speaker. He is a former managing chairman and managing director of Indian Bank to dissect the RBI report and translate its findings into actionable strategies for all of us. So without further ado.
Yeah, Banker, this time there are a lot of takeaways. As I start making a presentation, I would also, one has to be always on the toes. It's like, in Bombay, in Mumbai, you go and then catch the electric train in the morning during the official rest. Like this, you have to be proactive in preparing yourself to get into the train, to get out of the train. That way, RBI say that no, we are willing to take proactive and prudent actions, and to see why they want to take it. They wanted to ensure that absolutely there is no accumulation of risk and supports the needs of the growing Indian economy. India's growing economy, it requires a lot of needs. So you should be future ready. See how much message it gives. You should be proactive. You should be, they are planning that, no, they are estimating that it's going to become number 2. Take steps on the current as well as emerging risk to the stability of the Indian financial system. That is the task, and they are doing. Now, on June 27th, RBI came out with its report on the financial stability report. It's a half-yearly report, once in December, once in June, they come out. And then the latest report is June 24. Devolve more on the global economy, because challenges are going to come to the Indian financial system, not locally, globally. From global sources it's going to come, because we are financially integrated. What is happening there will catch us with us. So I am going to focus more on global, less on domestic. So the global economy, what is that? Compared to last, despite there is an heightened risk, we are going to see what are the heightened risks, and also there is an uncertainty. Uncertainty continues. It is vague. It's like a plane you are going where it is cloudy. The pilot is not able to have a clear vision. In the medium term, he is not able to have a clear vision. In the short, he is able to have a clear vision. That way, we are going. And then, see, again, it says clearly, near-term prospects are improving. India being an emergent economy, emergent economies, market economies remain vulnerable to the external shocks. So they say that, and there will be definite spillover globally. If there is there, you have to face these spillovers also. You are sure to have the external shocks. You are sure to have the spillover effect in your thing. And then the geopolitical conflicts. When Russia's invasion of Ukraine started, we thought it is going to be one of thing, but more and more the geopolitical conflicts are happening. And then there are also risks that are associated with the frequent geopolitical conflicts, and then there is also a risk associated with the technology and climate change. Okay, as we go further, what is the good thing that is happening? There is a good thing that is happening is, so there is no threat of hard landing, but at the same time, people were expecting hitherto that there will be a inflation is also continue to remain elevated globally, and also including the emerging market economies. And then the policy paths are increasingly expected to diverge. I mean, you can't expect a uniform path. Again, I would like to bring back to your memory what RBI governor has already said. He already said that there is a misconception that no, we are waiting for a Fed rate. No, we will play according to, in India, we will play according to, being a cricket fan. He said that according to the local pitch, according to the local conditions, we will do. So there will be no uniform. Equity markets are scaling to new heights. Credit spreads are also narrowing. Volatility, global growth is expected to decline by more than 100 basis points by end of 2020. That is 2029, 2030s. Again, risk in the private credit. See, in abroad, there is what is called, there is a component of private credit. And so in addition to this, needless to say, geopolitical risk. Because of this, the global financial system are also not able to have a clear view on the medium term as well as the long term. If you are not able to service, whether you will be able to roll over. 9 percentage points above pre-pandemic level. Why it has happened? Surely part of it is due to the pandemic era's expansionary fiscal policies, and China, they are leading in the increase in global debt. That is what the financial stability report points out. So the narrowing of the interest rate, see, there is another concept that is also taking place. Public debt is 97.7 trillion. Look at the private debt. Private debt is about 153.7 trillion. Definitely it will pass on what is called the spillover risk to the emerging market economies. If they are not able to recover, they run into a risk of higher refinancing cost. With the result, what will happen? They will not make it, they will not be in a position to make any investment in health, education, or infrastructure. This will lead to what is called vicious cycle of financial instability through impairment of government and private sector balance sheet. It will affect the balance sheet, it will affect the private sector balance sheet, which will have an impact on the IMF makes an appeal saying that global institutions, lenders, kindly consider measures. There is what is called non-banking finance companies. Globally, they call it as a non-bank. Commodity prices and the US dollar are moving in tandem. And then the commercial real estate prices have also declined sharply across the countries. So this is how it is going to create a thing. I have given enough inputs globally. Whenever there is a geopolitical tension, there is a crude oil price increase and bank deposit flows, with smaller banks being most vulnerable. There were multiple incidents involving payment and settlement system. Another thing, again, Global Financial Stability Report cautions, please go through the programming, review it, don't be complacent that no, we have handed it over to them. So go through the programming, ensure that it is updated at periodical intervals. Countermeasures require real-time monitoring and response capabilities using automated algorithms for identifying anomalous investment with collective action and sharing critical intelligence measures become vital. That is how I would think. So as bankers, we should be prepared for what is called as spillover effects. You cannot remain complacent saying that all is well with Indian economy, nothing will happen to me like that, because due to the globalization, real GDP rose to 8.2% in 23-24, up from 7%. I mean, whether you have no control, even though IMD has forecasted, assuming that it is going to happen, as a medium term 4%, it is to 4.7 today morning. When you open the newspaper, again it has increased 5.18%. Definitely pose a risk to the inflation outlook of the Indian economy. Exports and imports are also regarded a positive growth in the quarter of January to March 24. For merchandise trade would be conditioned by the strength of the global demand. What happens? Increase in freight costs, increase in transit time, etc. And there is a crowding of the ships. The freights are not available to carry on the export activities. So rupee denominated and foreign currency denominated non-resident deposits have also recorded inflows throughout the 23-24. Again, there has been a rise in both international liabilities and assets. And as a corollary, the buildup of the foreign exchange reserves has a strong linkage with the net capital flows to India. Inclusion of the Indian government securities in the JP Morgan Global Bond Index, emerging markets from June 24, and in the Bloomberg Emerging Market Local Currency Government Index from January 25. As we go there, despite the rise in interest rate, non-finance companies are exhibiting stability. And then fiscal consolidation is also taking place. As per the provisional accounts of the thing, the gross fiscal deficit was 5.6% of the GDP in 23-24. There is a moderation in the revenue expenditure, which is a good thing for a growing economy. The increase in the capital expenditure is improved toward the quality of the spending as reflected in the recovery ratios. As we see, bankers, this is one slide I would request your pointed attention. Now, for the household sector, saving in the physical assets has been the dominant and rising component. 2013 and 2022, their systematic investment plans play a role. The investment made through systematic investment plan form 19.6% of the total AUMs of the mutual fund. Know your competitive strength. That is why then again the banking stability indicator, capital levels, higher earnings, decline in the stock of NPAs, including the restructured assets, profitability indicators, ROE, ROE, NIM, etc. In March 24, despite margin decline, common equity tier 1 has also improved. Asset quality is also improved, as is reflected in the GNPA of 2.8 and net NPA of 0.6%, etc. And then special mention account SMA2 also showing low levels. There is a strong credit growth, robust trade driven by momentum, and then everything is good. The CD ratio of the private sector banks are above 75%. 24. After netting the merger of the HDFC with the HDFC Bank, as they stated in their approach to the financial stability report. Again, second lesson to the serving bankers. Convergence has been mostly achieved through shortfall in credit growth. What is happening today? They are saying credit growth precedes deposit growth. Normally, kindly ensure that you make use of your personal thing, establishing there is a asset quality of the unsecured retail loading also showing improvement. But nonetheless, in respect to the private sector bank, the share of the slippages from retail loans, again, growth in bank lending to NBFCs was an area of concern. Measures taken in November 23 have brought in results. So the growth has moderated to 18.9% in November 23. Further, it has come down to 14.6% in April thing. Banks yelled 64.6% in the L till maturity category. This is a part of the investment. Unrealized losses on the securities held in the HTM portfolios showed reduction in March 24. On an incremental basis, bank lending to NBFCs declined in second half of the 23-24 is also there. There is an improvement. Delinquency levels have also diminished across the financial institutions. Internet penetrations, cyber risk is emerging as a key, this one, and was placed under the high risk category in 8 out of the 10 previous off-years surveys. RBI is also starting to spreading awareness related to cyber security, and it is gaining momentum. Banks are also doing it. See, when you take into account the cyber incident, most of these incidents involve threat actors leaking regulated entities data such as credit card data, customers KYC details, KYC documents on the dark web, social media, or public platform for sale. Kindly ensure such a thing do not take place at your work spot, which stipulate regulated entity should report cyber incidents within 6 hours of the detection by third-party service providers. And then the next, as we move to the financial system stress indicator, the financial system stress indicator, a comprehensive indicator of the aggregate stress levels in the financial indicator, and 26% of the survey participants expect the asset quality to further improve in the banking system. 48% of the respondents assessed demand for credit would improve, supported by higher GDP growth, government spending, pickup in the manufacturing sector, etc., etc. BBB, triple B and above constituted 91.3% of the total externally rated funded advance to the large borrowers. Again, CET1 capital ratio is also good, constant implementation of global standards, etc., etc. Domestic regulatory initiative continue to work towards strengthening of the safety and resilience of the financial thing. Regulators are based on the principle of proportion. Financials will highlight the strengthening of the balance sheet of the financial institutions with a low level of impairment, robust earnings, strong buffers, etc., etc. At least little to your intellectual capabilities. Thank you, ladies and gentlemen, for your patience. Thank you.
Towards the end, Sundarrajan sir had to go very fast. I would hope that you will come up with the whatever you might have missed when he was speaking very fast towards the end. And now I'll request and Dr. Srinivas Rao for their observations. But before that, I just wanted to announce 23rd of July annual union budget will be.
Because 1.5 hours non-stop speaking with at this age, as a teacher, I am speaking for 1 hour, more than 1 hour. But I must appreciate 1.5 hours is not that easy. Domestic financial stability is in a better condition. It is resilient. But gross, if you see, that is still India is attracting a lot of foreign investment as well as portfolio investment. There will be some blip in the market if FI will withdraw. But mutual funds now is a force to reckon with. That is one thing. Second thing, when the problem is now is mostly something unusual. Unusual means, credit growth was forced because of this, COVID, not only in India, but also in foreign countries. That's why this debt profile has become something unmanageable.
So I'll just say that we'll be sharing a summary of this video. Of course, the video will be shared with all of you. So with that, we end today's session. Namaskar.